Well, good evening, everyone. Welcome to today's webinar hosted by the Investment Committee of the Lebanese Business Council in Kuwait, LBCK. My name is Sarah Abdel Samad. I'm a board member of the LBCK. On behalf of the Investment Committee and the Lebanese Business Council in Kuwait, I would like to thank you all for joining us. I would also like to thank our Business Council's partners for their support, the American, British, Canadian, French, German, Portuguese, and Indian business councils. The Lebanese Business Council in Kuwait brings together a network of professionals and business leaders with the objective of fostering economic collaboration, knowledge sharing, and meaningful dialogue across the Lebanese, Kuwaiti, and wider communities in Kuwait. Within this framework, the Investment Committee focuses on promoting investment awareness and creating platforms where investors can engage with timely and relevant insights. In today's session, we will be discussing investing through periods of crisis. Why does this matter now? As we all know, over the past few months, global markets have been shaped by a series of shocks, ranging from geopolitical tensions to ongoing regional uncertainty. These dynamics have had clear implications for inflation, interest rates, asset prices, and overall market direction. These conditions have not only created volatility, but have also tested investor behavior, often leading to reactive decision-making driven by short-term noise rather than long-term strategy. That's why today's topic matters. In uncertain times, discipline in asset allocation and a long-term investment mindset becomes even more critical, not just for managing risk, but for staying aligned with fundamental objectives. In today's session, we will cover asset allocation and the role of different asset classes, market outlook across key asset classes, including equities, fixed income, and real estate, and some practical recommendations for investors. Before we begin, just a few quick housekeeping points. This session is being recorded and all participants will be muted. You are welcome to submit your questions in the chat at any time, and we will dedicate the final 30 minutes of the session to Q&A. With that, I'll hand over to Ms. Dina Al-Rifai, who will be moderating today's session. Dina is the Executive Vice President, Head of Wealth Management and Business Development at Kuwait Financial Center, Markaz, with 21 years of experience in wealth management. Thank you so much, Dina, for joining us, along with our esteemed speakers, Mr. Sami Shabshab, Mr. Mahyiddin Krunful, and Mr. Wajih Bustani. Dina, the floor is yours.
Thank you so much, Sarah. I'm honored to be a part of this very important webinar. Let me just introduce our esteemed panelists. Mr. Sami Shabshab, who's the Managing Director of Margulf Management, the real estate arm of Markaz, with over 35 years of experience in the real estate markets internationally, 25 years of them with Margulf. And Mr. Mahyiddin Krunful, the CIO CIO Global Sukuks and MENA Fixed Income at Franklin Templeton, with experience of over 25 years in the development of MENA debt markets and Sharia-compliant finance across the globe. And Mr. Wajih Bustani is the SVP Asset Management at ABK Wealth, with over 20 years of experience at different roles of asset management, the latest being of SVP of Asset Management in ABK Wealth. Hello, gentlemen. Thank you for joining us today. And as Sarah stated, we'll start at the first part of our panel at the foundation, asset allocation. And I will be addressing the questions to all of you gentlemen. First of all, for Mr. Wajih, in light of the recent market volatility, how should investors think about asset allocation and long-term investing? And what is the role of equities, particularly within this framework?
Yeah, thank you, Dina. and good afternoon, everyone. And thank you to the LBCK for hosting this panel. Dina, I mean, to your question, I think with sort of the continued volatility that we're seeing in the market and sort of these crises that we're experiencing on an ongoing basis, it seems maybe more often than previous years. I think, I mean, this is, in my mind at least, I mean, reinforcing the importance of a proper portfolio construction and a more structured framework for allocating to different investments. And this is where I think building your portfolio based on strategic asset allocation comes into play. And let me maybe explain a bit, I mean, what I mean by strategic asset allocation. In my mind, at least, I mean, there are three, let's say, main tenets of a proper strategic asset allocation. On the one hand, it's a portfolio that's not built on chasing short-term trends in the market, and it's not basically built to chase also short-term views. Rather, it's a portfolio that's built to take advantage of the different features and characteristics of different asset classes, long-term characteristics. By that, I mean sort of return characteristics, as well as volatility and liquidity characteristics of those. Added to that, I mean, apart from sort of that, having that longer term view in terms of allocating to different asset classes, I would say the second main feature would be diversification in the portfolio. And here we're talking about diversification across multiple dimensions. First being different asset classes, and then within the asset classes, allocating to different geographies, different sectors, industries, currencies, what be it. It's basically to try and have an exposure that's more full and more replicating of the market as a whole, as opposed to something ultra specific and very focused on specific themes, specific securities, or in a way that's ultimately very concentrated. And finally, I would say, I mean, the strategic allocation is one that's built to provide the type of long-term returns that an investor would require while reducing the amount of risk that they're taking to achieve that type of return. And really, in this sense, I mean, every strategic allocation for every person could be different because we all have different long-term target returns as well as different abilities to take on risk. So, in summary, it's basically an approach where you're diversified, where you're looking through short-term volatility towards taking advantage and collecting the long-term benefits of different asset classes. And ultimately, it's one where you have allocations to these different asset classes based on your specific needs and your specific requirements. And here, different asset classes obviously have different features that kind of would complement each other. So, for example, and very sort of broadly, equities generally provide long-term returns. They're one of sort of the main drivers of long-term returns in portfolios, but at the expense of increased volatility. It's a very volatile asset class, as we all know. Whereas you have other asset classes that could maybe potentially help dampen some of this volatility that comes from equities and help achieve a certain return with potentially lower volatility on the portfolio, fixed income being one. And you can extend this to other tools and other potential asset classes as well that could play different roles. For example, private markets and allocation to private markets could enhance on the return that's available in the public markets, although be it at the expense of the liquidity of the portfolio. So a proper allocation is one where all of these different asset classes are weighted in a way to achieve your returns within your risk profile. And once that it happens, and once you take this approach, it kind of shifts a bit how you see volatility in the market and how you experience crises. So if you're holding a very concentrated portfolio, if you're playing very specific theme, when a crisis happens, the first thing you're thinking of is, how am I going to de-risk my portfolio? How am I going to, what do I have to sell in order to lower my risk? And typically, these types of decisions are very detrimental to the long-term returns and potential of the portfolio. Whereas with a proper asset allocation, that mindset shifts a bit from one where you're worried about your positioning to one where you start viewing short-term volatility as more of a potential opportunity to take advantage of. So here, for example, I mean, let's say you start off with a target allocation to equities at 40% of your portfolio. There's a correction in equities. Equities dip to 37% of the portfolio, for example. Just the fact of rebalancing equities back to your targeted long-term allocation is sufficient to be able to take advantage of short-term dislocations in markets to enhance your potential long-term return. You can also go one step further and overlay your strategic allocation with more tactical views on the market, more short-term views, smaller repositioning in the portfolio to kind of infuse a bit more some of the shorter term, let's say, trends in the portfolio. So I give an example. So the same example as equities. Let's say equities correct. Then you could make a decision not only to rebalance, but actually to say, you know, I'm a bit more positive about equities now, given the correction. They look a bit more attractive. I want to tactically increase my weight from 40% to maybe 45% to take advantage of this opportunity in the market. And this framework, I think, may be very helpful for a lot of investors to help them, one, ride through crisis with less anxiety and in a framework that can help them ultimately achieve their long-term goals. Now to your question.
Thank you. I think you've covered it very well with the equities, and maybe we can complement with a question for Dino about fixed income. How does fixed income and credit generally support portfolio stability and income generation, especially in uncertain markets?
So thank you for that question. And again, I'd like to also echo my gratitude for joining you all on this panel. It's a pleasure to be here. I think we touched on some really important themes. I'd probably want to just reiterate how important it is to have some self-reflection, to think about, you know, your own tolerance for risk, because often we have these conversations with friends and colleagues and other people, and you hear different, you know, what other people are doing. I think it's really important to really begin with an honest assessment of what your personal situation is and what your tolerance is for risk, obviously, and obviously everyone would like to have maximum return, but not everyone is as comfortable with the downside. Which brings us to fixed income, because, you know, we are obviously, you know, in general, fixed income is capped in terms of its upside, and, you know, we're obviously obsessed about downside. And so I think maybe a corollary to what we've been discussing is to also think a little bit around valuation. So when we're thinking about, you know, asset allocation, yes, you have the standard 60-40 or some starting point that you make adjustments, but I think we want to keep valuations a little bit in mind. And I think in the world of fixed income, things have changed a lot over the last 3-4 years. We went from 0 interest rates to today looking at 4 to 5%, for example, in the US, slightly higher in other parts of the world. And so to your point, Dina, we're back in a world where, you know, fixed income is actually generating income. And importantly, also now can provide more of a cushion for the volatility you could get from equities. This wasn't the case just a few years ago when interest rates were at 0. So I think that would be the first, I think, a point I'd like to highlight. And by most analysts today, when you think about their 10-year capital market expectations, almost all of them expect fixed income to generate more return over the next 10 years than they have over the previous 10 years. Well, that's in a little bit in a slight contrast to equities, where most people are expecting the next 10 years to deliver lower returns than the previous 10 years, just because of where we are in terms of valuations and multiples. So I would just keep these two in the back of my mind. And obviously, maybe I would add a third one, that fixed income. I mean, most of us earn in dollars or in pegged currencies, and we have a very strong bias for the dollar. And obviously, US equity markets are very large components of global equity markets and have outperformed so much over the last 10 years. I would try to pay, given the uncertainties we're all dealing with. I think this is a time where we want to have maybe the majority in dollars, but we want to be much more cognizant about the risks. And so I think thinking around gold, thinking around inflation expectations, thinking around different currencies, even if it's a little bit, I think becomes a little bit more relevant over the next 10 years. But broadly speaking, we are more today in an environment where you should be thinking about increasing fixed income allocations if it's very low versus removing them. And I'm not just saying that because of what I do, because obviously I want people to invest more in fixed income. But I think generally speaking, when I speak to my friends or colleagues, you know, most of them have money in the bank and they treat that as fixed income, but that's really cash. And it's very different. I would just, you know, have people take a proper look at their fixed income allocations and make sure that it's, you know, anywhere from 20 to 30, 40, 50%, depending on their risk tolerance.
I agree. From fixed income to real estate, and to the questions for you, Sami, what is the role of real estate and diversification and income also within a well-balanced portfolio?
Thank you, Dina, and good to see you all.
Yeah.
I hope we'll be in the same room soon. Now, from the perspective of real estate, including it in a portfolio, I mean, we all know the traditional wisdom of provides income, it provides capital appreciation. And the more dubious statement is that it's a hedge against inflation. And the hedge against inflation is a little bit tricky because, yes, it could work in the long term, but in the short term, it could work a little bit in reverse. I'll give examples. So the wisdom is with inflation, you'll have increased rent, and with that increased income, and therefore the property is more valuable because properties are valued based on the income they generate. If we look closer at that, we would there are properties, for example, office properties have long-term leases which don't adjust with inflation. Typically, they're set or there's certain bumps that may correlate or may not correlate to inflation. So in these circumstances, it's basically detrimental where your expenses increase, but your rents don't track inflation. Expenses do track inflation, but rents don't. But in general, if you take the long-term view, inflation, the real estate is a very good hedge over 5, 7, 10 years against inflation. And I think we all know it from personal family experiences that have invested in an apartment or some sort of asset that has over several years or sometimes decades have dramatically increased in value. But these are the traditional points they make. I mean, income, capital appreciation, inflation. But on a more philosophical level, the beauty, in my view, about real estate that it has a lot of utility. I mean, we essentially need real estate regardless of where we are in the economic spectrum, rich, poor. I mean, it's food and shelter. And food basically needs agricultural land to grow. Food goes to warehouses, then to retail stores. So if you look at it from that perspective, it's really the largest asset class by far. I mean, it's valued, if you look at worldwide real estate, it's close to 600 trillion. I mean, the figure is also not really, it's just a margin, but it's about 600 trillion, of which 500 trillion is residential. And if you just look at the screen, other than Wajih, who has a blue screen behind them, we're all sitting in some form of real estate. I mean, we own, we rent, go to work. So it has immense utility. And that, for me, distinguishes it from, for example, other commodities. Take gold. I mean, gold is, with my limited knowledge about it, is basically speculative. I mean, you can invest in gold, but you're not going to do anything with it. You're not going to rent it, lease it, generate income from it. Whereas if there is a supply-demand balance in real estate, you should be okay. So that's my view. It's beyond just it does provide income, but other investments do provide income. There's capital appreciation. And again, the hedge against inflation in the long term make it attractive. But I think, to me, it's deeper than that. It's essential to our survival. And hence, with that depth of a market, I think it should be in every portfolio. And it is, in fact, if you take on a personal level, you would look at people who own homes, etc. It's a large percentage of their net worth for a lot of people. I think for the majority of people is the real estate. Now, on the investable side, where we reside, is where we try to make money, where there's a supply-demand imbalance and try to capitalize on that. But it's essential, I think, in a well-balanced portfolio.
Thank you. Let's dive deeper into each asset class in terms of outlook. Wajih, how do you view the outlook for equities in the current environment, given the recent geopolitical development and the market volatility we've been experiencing?
Sure. Maybe I'll start by addressing sort of the elephant in the room around equities, which is valuations. Equities have been on a tremendous run over the previous years, and there is the notion that valuations are reaching maybe bubble territories. I don't particularly agree that we're gone that far into sort of those territory, but I wouldn't say that equities are cheap at the moment. So just to give you a few numbers, so and I'm going to maybe use sort of the S&P 500 as an example, being sort of one of the main indices globally, and the US being sort of one of the biggest markets in the world. So currently, if you look at forward earnings, I mean, the S&P 500 is trading at 21 times. Historically, over the last maybe 20 years, the median valuation has been around close to 17, 18 times. So by that measure, we can say, I mean, equities have gone a bit ahead of themselves in terms of where they are currently. However, I mean, if we look at equities slightly differently, instead of taking the S&P 500, looking at the equally weighted S&P 500. So instead of market cap weighted and equally weighted S&P 500, we'll see that generally the valuations there are more or less in line with their historical averages. So which tells me that in general, there are pockets, as always, of potential value within the market. Although some parts of the market, and here particularly maybe the tech sector, has re-rated significantly over the previous period and is probably trading at valuations that are a bit more on the excessive side. So having said that, we have to keep in mind something, that equities have a massive tailwind working for them, which are significant earnings growth. So for example, Q1 numbers, earnings in the US are up almost 27% year on year. Not only that, I'll tell you one more thing. The market is up 8% in the US since the start of the year. However, on future earnings, it has actually become a bit cheaper in spite of this rally. Why? Because earnings 12 months expected earnings have actually gone up by 13%. That's consensus estimates being revised upwards by 13%. So the multiple on future earnings actually went down from 22 to 21. I'm saying all of this to say that, yes, some valuations are a bit on the excessive side, but we're not really at a stage where things are tremendously out of order. So if in my sort of framework of looking at things from a sort of relative view based on my base allocation to equities, I would probably be on the more neutral to slightly underweight and look for maybe a pullback in the equities market to build on that and increase my exposure and maybe then go a bit more tactically overweight.
Thank you. Interesting. Although in the long term, as we know, equities outperform probably all asset classes. And it's just about what you mentioned in the beginning, Wajih. It's about if you have a well-balanced portfolio, then de-risking shouldn't be a panic reaction. I agree fully with that. So from equities to fixed income, and this question is for you, Dino, what is your current outlook for the fixed income? And do you see any dislocations today that maybe investors can focus on?
Yeah, I mean, so first of all, I don't disagree with anything that we've said. I think, you know, a measured approach, I think, seems very sensible, especially if you think about the fact that we've just gone through like a massive geopolitical shock. But if we look at the valuations in the market, I mean, they haven't really moved that much. Equities are today slightly up from where they were before the conflict started, and even bonds in the region and equity markets in the region are flat on a year-to-date basis. So we haven't had you know, very large shifts to trigger any sort of panic response or, you know, a massive shift. What I would say at a high level is that the market's response to this geopolitical shock that we're still going through has been persistently sort of underestimating the impact and the seriousness of the shock. So if you look at all the markets, from oil to gold to equity markets and even interest rates, we are generally pricing in a very modest inflationary impulse. And inflation expectations have gone from 2.2 to 3.2. So, you know, we're expecting things to be at the margin a little bit more under pressure, but no one is really thinking about an extended period of very high inflation or policy in the US, for example, changing dramatically. We've just gone from saying before the crisis we're going to cut 1 to 2 times, and to today 0 cuts, maybe 1 cut. So these are not very large shifts in expectations. You know, on the flip side, when we look at these numbers and we look at the yields on offer, again, I think broadly speaking, they offer decent value. If you tell me where there's value, I would say that real yields or long-term tips probably offer the most value today in the traditional sense. They're trading at the highest levels they've traded in the last 30 years. And I think given all the uncertainty we have, we shouldn't be demanding high real yields for 30 years in the environment. So I think that's where maybe there's value. But if I look at nominal yields on offer, which is what most of us get exposure to, so whether that's overnight rates or 10-year yields, or, for example, the bonds on offer here in the GCC from Saudi to Kuwait to banks, etc., I would say that the environment is pretty healthy. You know, credit, I think, has deteriorated. We're going to be feeling pain in our part of the world. There is a risk to higher inflation. But at the same time, we could be looking at much slower growth. We could look at demand destruction. We could be looking at higher oil prices for longer. So we could be in a situation where policy is quite uncertain. And so then the defensive attributes of fixed income come into play. But all things being equal, again, not to be very neutral, but Wajih was saying how his equity approach is, you know, I'm saying it's mildly expensive. I'll start neutral, maybe a little bit underweight given the uncertainties. I would say on fixed income, I would probably be similar, maybe neutral, slightly overweight duration overall, with a bias to a little bit more inflation protection. That would kind of be my approach. In terms of credit, I would say that I would still want to be in higher quality credits given the uncertainties we have. Because if this conflict ends up lasting for longer, or we have secondary shocks, or there's a sudden change in policy because of what's happening, I think that the higher quality you have, the better, especially when we're talking about our own investments. I wouldn't be recommending people take on very, excessive risk at the moment. But what you have on offer today, so if you look at the US curve, you're earning 5% for 30 years, you're earning 4.25%, 4.5% for 10 years. I think that's going to be a pretty good place to begin to get some income into your portfolio and to get you some protection if there's another wobble. And I think we're living in an environment right now where you want to be careful. It's a fact, it's uncertain. And then all of us living in the Gulf find ourselves also in a slightly unusual situation in terms of uncertainty. And my final point would be liquidity is another dimension. So we touched on it a little bit with the real estate, but I think we're also in an environment where we want to remain more liquid than we normally are. Just because we are in an environment where you may need to move, jobs could change, not to mention all the technological shifts shaping the future of the workplace. But I would generally say remain liquid, remain high quality, and try to take advantage of these elevated yields. Because if this crisis pushes us into a recession, even with an inflationary impulse that's larger than we think, you could end up seeing short-term rates rise and longer-term rates actually go down. I don't think that's an unrealistic potential outcome. So the yields, I think, historically are pretty attractive, especially at the long end. And I think you need to have some exposure to that.
Great, thank you. What about real estate, Sami? Where are you seeing, what's your outlook? And where do you see the most attractive opportunities, probably?
The most attractive today, I think, with all the uncertainty, and there is a lot of uncertainty, and I'm speaking strictly US and Europe, I feel that is a good bet in real estate. Instead of being on the equity side, be on the debt side. And that is providing very decent returns. As you know, we're working on a product together, which is between 8 and 10, and you have about 35% of equity ahead of you. That would be a bet I would make, and we are making. That's sort of a short term. Real estate is a long term play, and we can discuss this, which I think the fallacy of investing in real estate for 3 years or 3 to 5, I don't think is the best way to invest in real estate. But for today, if we have to invest, I would say that is key. And on the longer term scenario, I would go with senior housing, specifically in the US, because of the demographics. And within that sector, I would focus on, I don't want to call it higher end rather than luxury. And we've had good luck with it. There is a need for it, and there's affluence within a certain strata in the US that is underserved. And I think that would be where we would put, where I would put my money. So it's debt and senior housing. Now, the other thing I'd like to stress or bring up is the macro story in real estate is not something that I've believed in. And through the 35 years I've been doing this, it doesn't really reflect what you can do. You take the office sector. There aren't two buildings that are the same. You have markets, sub-markets, micro markets, big buildings, suburban office. So it's when you talk about office, it's just there's a huge range within that sector. Same thing, retail. Same thing, industrial. I can give examples of successful, unsuccessful projects in a up market. I mean, namely today in Ontario, or what they call the Inland Empire, which is one of the largest market in the US. Industrial buildings that are 30,000 meters, 300,000 square feet, are not being leased. Smaller works, bigger works, but that size doesn't work. So you're still within the sector, but you're not doing well. So you have to be it's very specific on the particular product you're buying or building. And you're not buying a piece of every, the macro story works in other sectors, but in real estate, you have to, it's really bottom up, I think, how people refer to it, is the way we've approached it. Because at the end, we're buying 3-4 buildings. Do we care about every other building on the planet or in the nation? We don't. It's as long as we know, have a reason to invest in that building, we may do it. We've invested in retail. In fact, post-internet in 2010, 2011, 2012, in a few retail buildings that were incredibly prime, and we made money. And you can invest in a sector that's doing very well and not do well. So it's very asset specific. And the only commodity-like asset class in real estate would probably be apartments for rent. Otherwise, I would look at the macro picture. I mean, probably more for what not to do than for what to do, but essentially focus on the actual building I'm doing. And for the macro picture, you can invest in a REIT, which is a public REIT, and have the liquidity. But otherwise, all the investments we're talking about are 2 to 5 to 7 years. And again, I would look at the individual asset, especially in a company our size or most of the companies in the Gulf, that's what you care about. The actual building, market, sub-market, location you're investing in.
Thank you. Maybe now we move to the last part of our panel before we take in questions. The more actionable part. Let's make it actionable. We're in regards to recommendations to investors, and these questions are for all panelists. Please jump in, whoever wants to give me the recommendation. Given the recent market situations that we've been in, that every panelist here spoke about, what are the practical steps that investors should take today to position their portfolio appropriately?
If you want, I can. Mine is very short because I will do exactly what Dino said. Dino took the wind out of what the cash, or I mean cash equivalent, because it's highly uncertain. So I would just, Dino said it perfectly. And on the short term, the visibility is practically nil or minimal, and that's all I have to say. Thank you, Dino.
Yeah, I would begin with, again, your risk tolerance. I think there's a lot of literature around what the optimal asset allocation, but even if we go back to when we were in college, I think we started on 60-40, 60 being equity, 40 being fixed income. I think you adjust that. Again, there's another rule of thumb that's quite healthy where you say your fixed income allocation should be 100 less your age. So for anyone who's close to 50, that's maybe your starting point instead of 60-40. And then I think you make adjustments based on how confident you think you see the world. I mean, I think equity can be a big chunk of that. I see some questions coming around alternative assets. You may say, I'll take out from both and add a little bit to there. But I would be very conscious about, once you move away from these basic building blocks and start getting into more difficult, less liquid, structured products or alternative assets, I think your product selection becomes something you want to basically pay for. You need good advice, you need good people, you want brand names, and even in those situations, it's difficult. So I think if we were keeping things super simple, I would say your risk tolerance, you figure out what your equity fixed income is, and at the margin, you think about how much cash you're going to need. If you want to have 5 to 10% in gold or gold equities or oil or any of these commodities that you're thinking about. And I think, honestly, that's more than you need to do for most of us. Think about your contingencies, think about what your family expenses are for the next couple of years, budget that, and then I think that gives you enough peace of mind. Use insurance as well. I think people never talk about insurance, but if you're young and have 3 kids and you're worried about not having enough money, take out the life insurance, that gives your family a lot of protection if something happens, heaven forbid to you or whatever. I wouldn't, those are other things we can think about until, especially for the younger audience who don't have the capital to invest. I remember doing that when I was 30. It wasn't expensive to take out a term life policy. When my 3rd child was born, I was like, look, I don't have enough money if something happened to me. Maybe that's a good way to complement what you're trying to do while you're building a nest egg. So again, it could be as simple as index funds and equities. Again, similar now, you have a lot of ETFs on fixed income as well. You have funds, cash, think about it. Think about the other, alt/commodities as some percentage allocation you're comfortable with, and that's it. And then you rebalance every 6 months or every year, and don't try to make very big moves at any point in time, because we think we know a lot of things. And, I've been doing this for 30 years. I guarantee you, we don't know as much as we think we know. It's a very humbling exercise. But I think this diversification is the best thing you can ever is the best thing you can do for yourself and your savings.
Maybe if I may add one more thing, maybe to what Dino was mentioning regarding diversification. I think, moving away from like an all or nothing type of mentality when it comes to investing. So if I'm worried about the markets, I sell everything, go to cash. That's, probably one of the worst things you can do, especially that the market doesn't wait for you. Either on the downside, you'd probably be selling into already lower valuations, and on the upside, you'll find that the market moves well ahead of your ability to kind of get back into the market. So moving away from this all or nothing kind of mentality, staying truer to your strategic allocation, as Dino mentioned, with maybe some tactical repositioning, smaller bits here and there. I would just add one more thing, just on the private markets part, and I don't know how practical this is, but we're seeing more accessibility and within the private markets. There are new products coming out. They're offering access to certain parts of the markets to individual investors that were probably not accessible before, particularly maybe into private credit, into infrastructure, and these are asset classes that have certain benefits. So you can think about private markets to some degree as analogs to their public markets that can potentially generate better returns at much lower volatility, but of course you're giving up a lot of liquidity. So be very mindful of that when allocating to private markets.
Yeah, I think, sorry, on that, I think there are today, the new innovation are evergreen funds. So it's giving people access to these managers, but they still provide some liquidity. Obviously, in the last year, we've tested, these liquidities, and, some companies have gone into, difficulty meeting those redemptions, but it's still a preferred option thinking about liquidity. So I would just go back to this idea around liquidity. I think, when we have the uncertainty we have today, it's useful to keep in the back of our minds. And I couldn't agree more with Wajih's idea of don't be too extreme. An extreme view means that you have very high levels of confidence in what you're buying or selling. And I would caution anyone, to have that confidence right now. Nothing too extreme would probably work well. At the risk of being conforming to some extent, true. But again, no matter how strong your conviction is, it shouldn't be 100%. You know, everything should be measured and, you know, sensible. It has to pass a sensible test. The final thing maybe is we may want to be thinking a little bit around some international equity exposure. Again, these don't have to be necessarily, you know, high risk emerging markets, but you know, you have, if you bought consumers or you bought high quality European or a high quality global index, that could be a good complement to your US exposure as well.
I think maybe you covered what not to do, but I'm going to ask this question anyway. What's the worst? I mean, we covered what to do in these times. What would the worst thing ever? What's the biggest mistake you can do in these times?
Mistake.
I think, yeah. Go on.
Yeah, again, just to reiterate a point I already we already made, is just being too rushed into selling into panics and locking in losses. Obviously, the more diversified you are, that gives you the confidence to stay in the market a lot longer and see through these short bouts of volatility. And that's why it's important to get into these crises with the right positioning, so that it gives you the ability to stay invested in the market and not be a forced seller. Because ultimately, I think, I mean, when markets move, they'll move very quickly. Just to give you maybe some numbers on this. So if you were, and this is something JP Morgan has done in terms of research. So if you've looked at last 20 years of performance in equities markets, so you've generated roughly around 8.5% over the last 20 years. But if you've missed the best 10 return days over that period, that return halves almost. So drops from 8% to even less than 4%. Just to tell you that being in the market is the best approach, and not trying to time the market. That's I mean, one of the main mistakes you can potentially make.
Agreed.
If we're being super transparent, and I look back at all the mistakes I've done, I think taking anything excessive, you know, with leverage, you know, so big bets I would generally avoid doing, no matter what age you are. Making investments because you're friends with someone, or you know, they brought something that you think is the best thing since sliced bread, and any of these type of scenarios, honestly, I'd look at that like lending money to friends. Like, you can do it, but don't expect, you know, you're not doing it for investment. It's a different motivation. Yeah, and I think ignoring or not spending some time with yourself and your family and wife, like to really think about your, you know, the milestones that are coming up, you know, your liquidity needs and your risk tolerance. I think that third one, really, most people don't spend enough time thinking about, you know, what they're willing to lose and what payment, you know, what obligations they have upcoming. Like those are the basic questions, I think. So if you can avoid, you know, the social aspect of things and really focus on your real needs, I think you're already like 80% there.
Dina, was the question what mistakes we've done, or what mistakes investors
what not to do?
Because the other
What
one
not-
has,
what
we need
not
much
to
more
do.
time. We need much more time for the mistakes that we've done individually. But for the, I mean, one thing, it's not really a mistake, or it's an observation that we struggled with in the business I'm in, which is real estate. I mean, it's a long-term product, and where we've done a lot of money for our investors is where it was a long-term investment. Just its nature is a long-term investment, and putting that investment in a box of 2 to 3 years or even 5 is not ideal. Certainly, you should get longer-term debt on any investment you do, because cycles will hurt you if you don't have debt. But this is what we struggled with our investors, and that's one piece of it. It's not a mistake; it's a preference for the investor. But I think doesn't reflect the underlying asset they're investing in. So that's one issue. If they want to do that, I mean, a REIT is a vehicle which gives liquidity and stuff like that and diversification. But when you go into an individual asset or set of assets, I think that exposes you to unnecessary risk. The other thing that we struggled with is, and I still don't quite understand, is folks in the Gulf with high net worth are still interested, focused almost entirely on current return versus capital appreciation. I mean, they would look, it's just a comfort that we've struggled with to convince people, no, I mean, but this is a multiple of 1.6 or 1.5 versus a 7% interest rate over 3 years. I mean, just someone who needs the coupon, I can understand it, but someone who does not, we still struggled, as you know, with our development product that has historically outperformed, we don't want to jinx it, but has outperformed by measures of magnitude the income type of scenario. It's not a knock, it's just a preference that we feel investors would have been better off had they done what the development or the multiple view as opposed to the distribution over 3 or 4 years.
The income and the liquidity component of your asset allocation, I think, are important questions. So, you know, if someone needs the income, like Sami is suggesting, then great. But if you're getting it somewhere else or you have enough fixed income, then there should be a limit to how much income you're expecting from your portfolio reasonably over the long term. And similarly, I think the liquidity, required is also an important question you want to answer before you decide on your strategic asset allocation. But I think everyone here should aspire to have their own strategic asset allocation.
And the tools are a plethora of tools right now. I mean, you can start small, you can go to professionals, you can have professional advice actually through all the platforms.
Not to mention ChatGPT and Claude, and you can get personal with them and really tell them what you need and where, and you can double check those against other sources, other service providers. This all empowers, I think, the individual investor.
And even what you mentioned, about the private asset classes, and we have a few questions here. I will, once we close the session, we'll answer them. Recently, there has been a democratization of those asset classes. These asset classes were typically more institutional, locked up for many years, especially for infrastructure, talking about anywhere between 7 to 10 years. And now they're evergreens with much lower minimums, and placement is available with most investment companies in the area, in the region where it hasn't been before. So this is an even added value to the investors, where they'll have access to more investment options, be it a little maybe less liquid than fixed income and equities, but still it's a good component to have in a well-diversified portfolio. We have a few questions here for you, gentlemen. Thank you for participating in this very interesting, in these very interesting times, and the volatility and all of the uncertainty and the news we keep hearing every 10 minutes. It's not easy at all investing in this environment, or even participating in a webinar where you're actually trying to convey an outlook for any asset class. So thank you very much. We have a few questions here. The first one maybe is addressed to all speakers, and it's related to what Sami mentioned about inflation. How else can one manage inflation given what's happening globally, other than real estate?
So, you have different tools. So it's a tricky one. Inflation is not, and it's not intuitive for the average person. And I can understand how it also triggers a lot of fear because, you know, everyone knows by experience that $100 from 30 years ago is not worth, you know, $100 today. And we'll all worry about, you know, what's going to happen to our money 10, 20, 30 years from now. Which brings us back to what we started around with compounding and the right asset allocation. You're going to be doing a lot to sort of address those needs. But specifically, I think in the world of fixed income, I think there's two things you want to think about. One is, I think you do have inflation protected securities. So that's one option, you know, for, you know, the US dollar. There's also some diversification by currency. So if you think about some emerging market fund or index or something like that, that can give you some protection, and to a much lesser extent, but you've got some alternative assets, commodities, gold, real estate, all of those. So you could then think about maybe increasing your allocation to those asset classes if you're worried about it. But probably the best protection, honestly, over the long term is going to Wajir, would be making sure you have the appropriate equity or enough growth within your portfolio. So that technically probably your best protection.
And from my perspective, it would, I mean, be real estate as well, but long term, again, it's because what happens is when inflation comes in, kicks in, interest rates go up. So basically, on a short-term basis, your NOI may increase, but then your value, because I mean, everybody buys the real estate on a leverage basis. I mean, today is a perfect example. Rents may have increased, assuming it doesn't hit an affordability limit or some covenants in the lease. But let's assume it increased with inflation. Interest rates increased. So on a leveraged basis, you're backwards. But on a long-term basis, I would stick real estate. Sorry, not that the other products don't, but real estate is a good hedge if you think of it on a long-term basis against inflation.
Got it. Wajir, you have something to add?
I would just say, I mean, just to Dino's and Sami's point, I think just maybe sticking to a longer term view. I mean, dealing with inflation over the short term, as both have mentioned, I mean, it's very tricky. Different asset classes that you think are naturally hedges to inflation, like gold or otherwise, have a very mixed track record in terms of dealing with inflation over the short term. So I would say it's about sticking to sort of the long-term view and sticking to your long-term investments and on sort of the expectations that ultimately asset prices will reprice and will ultimately deliver the real returns that you'll need over the long term.
Yeah, and I would add on fixed income, I think your approach has to be also slightly nuanced, and you don't want to have all your money in one maturity bucket. So for the average person, it would mean having maybe a third of your fixed income portfolio and something that matures within 3 years, because that means you always have at any point in time some money coming in that you can reinvest. You have a good portion that's in that 5 to 10 year bucket, you know, call that another 30 to 50%, and then you have some call it 15 to 20% in those inflation protected securities. I think some combination, one third, 50%, something to that effect would be a sensible all-weather approach.
Thank you. And please, the audience can share any questions they have. I'm reading the chat box. Please keep them coming. There's another question in regards to what's the proper percentage, if you will, for asset allocation in the private markets. Anything that's, I'm guessing, not liquid, private credit, infrastructure, real estate. What would that look like as a percentage in a well-balanced portfolio?
Maybe I can start with that. Maybe take a stab at it. So, I mean, one way of maybe thinking about if you look at some of the more institutional investors, the big endowments, the big sovereign wealth funds, I think they typically tend to allocate around 20 to 40%. So it's a range. So you can take that as potentially a benchmark. But keep in mind that, I mean, ultimately, the ultimate allocation to private markets has to suit your own liquidity needs. To Dino's point on sort of some of these semi-liquid funds that are coming out that have enhanced the liquidity of private markets, I would still say, I mean, you should treat them as not liquid, as more of semi-liquid, which means that potentially when there is market stress, the liquidity will not be as available as you would hope for. So keep that in mind when allocating and maybe looking at some of these endowments as sort of offering a benchmark for the potentially the optimal allocation to private markets. That could be a starting point, I guess.
I agree. And even without the stress of redemptions, typically those evergreens have a 3-month, like they're quarterly redemptions with a 2-month cutoff date before the quarter. So technically, it's about 6 months before you get your money anyway.
100%. You have some lockup periods, typically, or some at least soft lockups with some penalties. So all of this, I mean, has to be worked out when it comes to finding your personal ultimate tolerance for how much you want to allocate to private markets.
And I think they're going to continue to be just performance-wise under a little bit of pressure, right? I mean, with rates being high, potentially even higher, still all these uncertainties. I mean, in general, I would say that, you know, there's going to be a dispersion in returns, and you know, the concentration of assets in, you know, literally something like 4 managers control more than a quarter of the assets in that $8 trillion space. So again, the quality of the manager, I mean, can't be, you know, underestimated here. So if you think you have access to someone really good at a reasonable price, then, you know, maybe. But I think for most individual investors, that number shouldn't be very large. And I don't think anyone's making the kind of money endowments make. So I would be on the more conservative those.
I agree. I have a question for Sami here. Maybe you mentioned it while we were discussing the real estate outlook, but are you more in favor of the real estate credit or real estate equity, given the environment in the US and Europe?
Today, certainly credit, the appropriate credit, but definitely, I mean, not knowing, I mean, we don't have visibility, and often we don't have visibility. I mean, there are, I think, if probably 40% of the time, 50% we have visibility. When, for example, the internet craze happened, you could tell when you start developing industrial product that, okay, there's a lot of momentum, leasing is immense, you can see. But in general, visibility, I say 50% of the time is unreliable. With that, we've done that. I really like that because you have 35% of equity ahead of you, and the returns are sometimes superior. And today, so I would do that, the short answer to the question. Yeah, so, but again, yeah, that's it. I will certainly do that. And the issue, again, what we see being marketed in the market is sometimes the existing product that I think deliver what's in the brochure, not to ding on any competitor or any, are not realistic. I mean, today cap rates are at 6, debt is at 6. You're not going to get positive. You're not going to get 8-9% distribution or a 10% IRR unless something very positive happens. So I would stick.
But you're referring to that in terms of income play.
Yeah, I mean,
but equity on development is something different, right?
Yeah, we'll do that. But again, back to the specific asset. I mean, on that, if I can have a minute, it varies immensely. For example, we're building industrial leasing is slow, but we found a site next to the Samsung facility, which is producing chips. The government, the US is despite the whole insanity. They're trying to move chip manufacturing. They are moving some chip manufacturing to the US. So there's one, Samsung is a $40 billion facility in Austin. The SMC is in Arizona doing $160 billion, something magnificent. So a site next to it would make sense, but that's a very specific story. This is why I'm saying, do I rely on the macro picture? I do not. There has to be a reason for that asset to exist, and that's what we go for. So yes, developing these two projects, we are in the middle of it. The activity is great. We're very confident we're going to do the second one. That's a teaser next to the Samsung asset, because the first one is doing very well. So these are specific. We do specific equity, but as far as a general, again, macros, if you want to, contradicting myself, would be debt, real estate debt. But you have to be selective. It's shorter term. Typically, they're bridge loans of 24 months or so. Okay. That would be a more secure play, knowing the ambiguity in the market.
Thank you, Sami. I have a question for Dino here regarding the MENA bonds and Sukuk. Do you believe the yields are reflecting the regional risk? And what about the regional perpetual bonds?
So first of all, I think it's great that Sami just gave us a confirmation that credit or debt makes sense in this environment. But no, seriously now, look, broadly speaking, the valuations in the markets haven't changed. When before the crisis came in, we were already of the view that things were fairly rich and we had a bias for higher quality credit. And now we've gone through 10 weeks of what can only be described as a less than thoughtful conflict. That's probably not going to plan. And there's still a lot of uncertainty around it. But when you look at the valuations, they are still very similar to where they were before. So my inclination is to think that, probably not, things are pretty rich as well in our markets. But I also, when I look at things on a relative basis, then, I can sleep a little bit better at night because I know that the fundamentals in this part of the world are really much better than many parts of the world. And just at a high level, you look at most of the developed and developing world, they're really dealing with a lot of debt. You take the G7, with the exception of Germany, everyone has debt to GDP above 100%. Everyone's running fiscal deficits north of 5%. The world is on an unsustainable sort of debt trajectory. And when you look at our markets here, there's obviously some nuance from one country to the other, but broadly speaking, the GCC is about 30% debt to GDP. Deficits are low. Our sovereign wealth funds are almost today at 4x of our GDP. So there's a lot of financial buffers or resources to manage what is a very difficult geopolitical situation. So I would say that the region definitely demands or should command a healthy allocation. Could you have all your money in the region? Then we go back to what we were talking about earlier. I would never advise anyone to have all their money anywhere. I mean, I'm Lebanese. I told my parents not to have all their money in Lebanese banks. I didn't think we would end up where we were, but look at what can happen. So, I think the GCC is in a great place right now, but when you're buying a 10-year bond or a 30-year bond, a lot of things can happen. So my advice would be, it definitely warrants an allocation for any dollar-based investor. It can be even 10, 20, 30% of your money, but it shouldn't be all of your money. And that's where I would leave it. In terms of where we have pockets of value, you mentioned the banking systems. We looked at all of those in quite a bit of detail during the conflict because our default assumption was this war will last longer. Who will do well? Who will survive? Who will face struggles? And if you think about the pockets of stress, it was only Bahrain that was under quite a bit of stress, and it was the tier 2 real estate companies in Dubai that were under quite a bit of stress, and to a lesser extent, some of these bank perpetuals. Generally, I would say all the banking systems are in great shape. Certainly the Kuwaiti, the Qatari banking systems, we didn't identify any bank that could come under some some pressure from rolling over their subordinated debt. The UAE, we identified a couple of banks, but I won't mention specifics. But broadly speaking, there's good value on the banks. The subordinated issues are giving you 2 times the spread. It doesn't sound like a lot of money yield-wise. And the one's paying you 6.25, the other one's 5. But that's like, double the spread. So it's a healthy pickup margin. So I would say that our banking systems are okay, the sovereigns are okay, the quasi-sovereigns are okay. The investment grade corporates, the Kuwait's, DP World's, well-managed companies are all okay. So I don't see a lot of immediate risk to those, and I'd be more than happy to keep allocating to them. But just philosophically, again, don't put everything in the region, even if the region looks great compared to other parts of the world.
Thank you. A couple of more questions here. One to Wajih. It's in regards to infrastructure. Maybe we touched upon that, but can you discuss the allocation to private infrastructure, given that it's becoming more popular?
Yeah, sure. I mean, it's an interesting asset class. I would say one that's becoming a lot more accessible, obviously, to individual investors. We see the arrival of a lot of these evergreen funds that invest in infrastructure. I would say, there are interesting drivers for infrastructure. One being, the massive demand for capital to be invested in infrastructure across for multiple reasons. One, there are certain themes and trends that are demanding massive capex, like the digital infrastructure, energy transition, and the like, as well as more traditional infrastructure that requires massive overhauling across multiple markets, where you have the historically main provider of capital, governments, being very much constrained in terms of their ability to provide this capital. So this is offering quite a decent opportunity, for private investors, private capital markets to come and participate. And the asset class itself, if it's properly done and as advertised, if you want, does have certain features that that investors can take advantage of. For example, more, let's say, contractual cash flows, more cash flows that are linked to inflation. So offering some sort of inflation hedge, some sort of defensiveness as well. So not only do you have long-term contracts, but also contracts with supposedly decent investment grade type of clients. And ultimately, it's very much underpinned by hard assets. So I would say all of this offers an interesting and decent potential investment for clients and investors.
Thank you. We have a question here for all speakers for why we don't see opportunities in the Chinese market or in China as a type of diversification for investors in Kuwait.
I think there's great ETFs on Chinese equities you can consider. So when we were talking earlier about some geographic diversification, I think global equity indices or emerging market indices or Chinese market exposure, I think for people like us, make sense. And I would add the valuations on Chinese equities are much lower than their U.S. counterparts. So I would seriously look into that personally.
Yeah. Maybe from my end, at least myself, I have the perception that Chinese capital markets are probably not as open or accessible or quite as developed in maybe some other markets. Ultimately, at least on the equity side, China still remains within emerging markets. So by that nature, it kind of maybe caps how much you could allocate to China. Apart from that, like any other economy, they do also have their own challenges. Ultimately, it's not all positive, rosy story in China. So I would say, I mean, definitely within a global context, you should have some exposure to China, although it should be kind of in line with what the market can offer in terms of potential access, exposure, diversification, and so on.
I think, Sam, you have a story about China.
I mean, yes, no. On the real estate side, my lifelong friend and colleague Ali Khalil of 40 years, we went to China in 2005 to try to see if we can do anything in real estate. And it's at first, the scale is huge. Repatriating your money after you sell the project is a 3-year process. The only way it could be, I mean, I'm sure there are, we don't know of folks who went our size and were successful. Actually, we don't know of anyone who went there our size. There are a bunch of Australian companies, Macquarie. I mean, if there's an interest there, but it's not on that point. Why would you want to go to something that exploratory versus something that is more secure and will produce the returns? I want to give an example, if I may, just a simple example. I mean, would we do a data center today? I would opt for a data center. There's a lot of buzz around it. I mean, it's not China, but going outside the norm is risky. Definitely going to another country is risky. Other currencies, you don't know the law. I mean, it's not for the faint of heart, and we opted not to do it. In fact, we went to Japan and Asia because Asia is the future. It's not for us.
So I don't disagree with less liquid investment and private capital and kind of direct deals. It's a challenge, but just again philosophically, it's a quarter of the world's equity markets. It's a third of the world's fixed income markets. If we want to have exposure that is broad-based, global, most people have zero in China.
Yeah.
I mean, if I just look anecdotally, most people have nothing. And I think it's a mindset change. So, I mean, personally, go visit. It will change your perspective. Of course, something you don't know, you shouldn't have too much money. Again, remember the common sense approach. You wouldn't go from 0 to 30 overnight, but should you have maybe 5 or 10% in, say, the best managed or public or liquid companies in China? Their banks, their Alibabas, their Tencents, I think for me, it's a no-brainer. I mean, I'm not doing daily due diligence on, the 10 largest U.S. banks or 10 largest companies, but I'm still allocating to them. Passively, I'm talking. So I think you can take a similar approach and think about China in a geopolitical context, in a global economic context, and think like I should have some exposure to that story. It's a different dynamic, different rule of law, different currency convertibility. There's a lot of issues with it, but between 0 and 30, I wouldn't be at 0. I would be at 5 to 10, depending how much work you put into the allocation. But I wouldn't ignore it for the next 10 years.
There's a question for you, Dino. I think we also touched upon it, but maybe you can offer your view. It's about private credit. What's your view on private credit given the negative news, the asset class, especially in the US?
Yeah, I mean, I think there's a lot of negative news on it. Let me try to, I mean, I think it's a little bit overdone. But again, I mean, I'm not involved day to day in US private credit, but we have obviously an $80 billion business, and I speak to my colleagues there. And obviously, they're going to tell me a more optimistic scenario. But here's what I would give everyone. In the US, the growth of private credit went hand in hand with the growth of private equity. So when it started, you had $5 of private equity raised for $1 of private credit. generally. That ratio became 2 to 1. Now it's 3 to 1. So still, for every dollar invested in private credit, you have $3 of equity that's going before you. I think Sami mentioned how in real estate that's very important, that equity component that gives him comfort that they will lose before his credit to the real estate project loses. So similarly, private credit generally have $3 of private equity that loses before they lose. So there is a buffer. I'm not saying that there's not going to be losses. There will be some bad managers, but I mean, I don't think it's going to be the type of dislocation that everyone is thinking about. I think it will take time for these losses to get realized, and there's quite a bit of cushion. So I don't see a need for most people to invest in private credit, frankly, from a retail point of view. At the margin, like we said, some evergreen funds. But I don't think that's going to be the thing that unravels. And the growth in the U.S. remains pretty resilient. We're not seeing, we were just talking about earnings being still okay. Yes, there's stocks potentially on the way, adjustments. But yeah, I wouldn't be as, I don't think it should be a massive investment for most people, but I'm not as worried as the quote unquote public is worried about it. I think also what I would add is in our part of the world, there's an enormous opportunity for private credit to develop. And if people want to take exposure to private credit, I know it's a very different dynamic, but they can think about this part of the world as well. There's a lot of different managers trying to chart things. But again, new markets, new products, not too much exposure to begin with. Start a little bit and then you can increase over time.
I agree. Thank you to our panelists. It was a very enlightening conversation. Thank you to the Lebanese Business Council for this opportunity, and thank you to our audience who participated with the questions and their presence. Anyone wants to add a closing word?
I think Sarah's on mute.
Sarah, please unmute.
Thank you to our esteemed moderator and speakers for such an insightful discussion. And thank you to all our attendees for joining us today. We hope this session has provided you with some clarity, perspective, and a more structured approach to navigating today's markets. We look forward to welcoming you again at our future events. Thank you, everyone.
Thank you.
Thank you very much.
Bye-bye.
Thank you. Bye-bye.
Thank you, everyone.
Thank you.
Bye.